Hello class, welcome to our exciting lecture series on principles of accounting or financial accounting, and I'm your instructor, Dr. Jamal. So today we are starting a new chapter. Up till now we have covered the two parts of current assets. So right now we are discussing the left-hand side of balance sheet, which is the assets, and assets include current assets and long-term assets. So among current assets, we discuss cash and accounts receivable. Today, we will talk about the inventory, how in accounting we treat inventory. So here comes our first learning objective, that is show how to account for inventory. Let's just talk about that. So remember, merchandisers have two accounts that service and titles do not need. So remember, accounting does not mean that accounting is needed only in production facility. It can be also needed in service company as well. So the difference between service company and production company or merchandiser company is that in merchandiser you have physical goods, and when you sell them, those goods that you sold, you also have the cost of goods sold. So we have two accounts that we need to maintain in addition to service company. In service company, there is no need for inventory and cost of goods sold. All right. So the service company income statement looks like here: revenue minus expenses is equal to net profit. But when we talk about the merchandiser, then there's going to be a multi-step income statement. Sales, cost of goods sold is equal to gross profit. Gross profit minus all operating and selling expenses is equal to operating income, and then you have all the income taxes and interest expenses, you get net income. All right. So the difference between service company and merchandiser is inventory. So when you have inventory, if you are a trader or you are a merchandiser, those who are making goods, you have a factory. So in that case, you need to operate at least two accounts. One account is for balance sheet and one account is for income statement. So inventory would be on income statement, while cost of goods sold will be on, sorry, inventory is on balance sheet, yes, and cost of goods sold will be on income statement. All right, guys. So let's move forward. So similarly, there's a difference between the balance sheet of service company and the merchandiser or manufacturing company or retailers or traders. So in service company, you don't see any inventory here, but in manufacturing company, you see the word inventory here. All right. So how we are going to show the inventory on the balance sheet and on the income statement? So assume we have a family dollar store which has a stock of 300 towels at cost of 3. All right. So this means this is in stock. All right. So when they transfer their, when they make all these goods, these towels, and place it to their inventory store, what is the cost of those 300 towels? 900. Family dollar stores makes each towel up to $2 and sells 20 of the towels for sells 200 of the towel of 5 each. All right. So now you have new information that out of this 300, 200 has been sold. So So how much left? 100. What is the cost? 3. So these unsold items will be the part of balance sheet and will be written as inventory multiplied by the cost. So some students, they multiply it with the sale price. When you multiply with the sale price, you are assuming that it has been sold. So it won't be shown on balance sheet. Balance sheet items are different than income statement. Income statement show you what is the revenue and what is the expenses. If you multiply this with sale, you are assuming that, okay, sale gonna be in balance sheet, which is wrong. All right. So left item, unsold items in the stocks, they are a part of balance sheet under the account for inventory, and it will be multiplied with the cost. Cost of production is 3. So this 300 will be shown on balance sheet. And how is we are showing our income statement? So how much you sold? You sold 20 at which 200 at the price 5. So what are the cost of these 200 multiplied by 3? So you see here, this 600 is coming from, so originally you have inventory 300, your inventory cost was 900, and out of 600 you have sold, and you make up 2 profit for each towel. So if you multiply 2 with the 200 you sold, so your gross profit exactly equal to 400. All right, guys, you understand the difference between cost of goods sold and inventory and sales? Tara, Meena, understand? Kaik, Priscillo, Noon, Miria, Marco,
Yep.
Yes.
Subhan,
Yes, sir.
Yes.
Oliver, Pavaroon, PD, Venetia, Momo.
Yes.
Okay, guys, stay with me. Today I need your participation because it's going to be hard for me to speak because I'm not feeling well. Okay, so please, time to time, participate, automatically participate. Okay.
Okay.
So the cost of inventory sold shipped from assets to expenses. All right. So in previous example, we have discussed that we purchased or we had 300 towels. These are units. Our cost was 900. And when we sell 200, we showed it on balance sheet under cost of goods sold. So remember, so the idea of having inventory is that the unsold item that you or unsold goods, which goods? The finished goods. Some goods are semi. Welcome back. We have a small glitch. Let me share you. So guys, now can you hear me?
Yes.
Yes.
Sorry about that. There was an internet glitch. Okay, so the idea behind is that whatever we sold, all right, so as a company, when I make goods, so my idea is that I'm making these goods for selling purposes, right? So all those things that I make should go to the income statement because income statement include revenue minus cost is equal to your profit, right? So only those items which are not sold, and remember finished goods, because when you purchase raw material, there is a raw material inventory. It convert into work in process or progress, which is unfinished goods, right? And then it goes to finished goods. So all these are your inventories, right? So all these unsold items or remaining item or balance of raw material, balance of semi-finished goods and balance of finished goods will be part of your balance sheet. So ultimately, whatever you sell, so that cost you shift to income statement as an expense. So in previous example, how many units you sell? You sold 900 units. So cost was 300. So that's why out of 900, 600 shifted to the income statement as an expense. All right. Now, sale price for this versus cost of inventory. We just discussed that. So sale revenue based on sale price. So number of units sold, not the number of inventory in the stock. Like in previous example, we have inventory 300 and 200 will be sold. So revenue going to be sold item multiplied by its sale price. Sale price was 5, so not 3. Okay, so you must consider sale price with the inventory sold, not the total inventory. Similarly, cost of goods sold, those items you sold, what are their costs? So it would be 200 multiplied by 3. So here we go. Here. All right. And now what is left for inventory? Remember, number of units inventory on hand. So left after selling, how many units? Then multiply by the cost of inventory. So per unit cost for cost of goods sold and inventory is the same. The only difference is sale price. So sale price will be under selling. All right. So number of units of inventory determined from the accounting records. So how we find out how many units left? So simply we have a maths, we do mathematical stuff through accounting records, we can find out, or at least one a year we physically count those items. So you heard on, I think, number of occasions from your parents, from your friends, from your teachers, or from your bosses that okay, new audit is coming, inventory audit is going on, you need to go to the stores and count all those stuff. So the word auditing in inventory section is basically this: you are physically, counting the inventory in hand, whether the accounting records must match with the physical records on the store or not. All right. So consigned goods, so does not include those held for another company and does include those out on consignment. So question is, when you receive the order, for example, you have 300 towels, you receive the order for 200 as a sale, and customer said, send to our doorstep. Now, remember, this will not less from your inventory. Sorry, my people is stuck. So this will not okay. So this will not basically deducted from your inventory unless the possession of the goods has been transferred to the